exposure to gold, bearing in mind stocks have done so much better and it's maybe time for a catch-up in gold. Where do I think it's going to go? I think we'll probably go somewhat higher in 2025. My target for 2026 is, I think we'll be well within the range of 3,000 to 7,000. I'm going to say high 5,000s probably. And that would merely be playing catch up with the level of government debt. The amount of the government debt has been increasing since 1971. So just playing catch up would take us into the high 5,000s. But of course, it would have to go an awful lot higher if they wanted to have any form of backing of the currency with gold.
The speaker, Clive Thompson, expects investors to increase their gold exposure as it lags behind substantial stock market gains. They predict gold will rise in 2025, with a 2026 target between $3,000 and $7,000, likely around the high $5,000. This projection reflects gold catching up with the growth in government debt since 1971. However, gold would need to rise significantly if used to back the currency. Clive Thompson, a Canadian journalist, author, and public speaker, explains that from 2000 to 2010, gold surged by 300% while the S&P 500 declined. However, from 2010 onward, stocks soared, leaving gold stagnant and frustrating long-term holders. Many who bought gold at its 2010 peak are now selling, driven by missed stock gains. The speaker anticipates that investors will seek alternative assets like gold once the current boom in top U.S. stocks slows. In a hypothetical currency crisis, gold must reach $70,000 to $150,000 per ounce to effectively back national debt, though this scenario remains unlikely. Clive Thompson exposes technology stocks trading at very high multiples, with shareholders' earnings lower than those from safer investments like time deposits. While these companies are experiencing significant growth in profits and sales, their valuations remain stretched, and it may take several years for them to reach more reasonable price-to-earnings ratios. Some of these companies could even fail, leading to potential losses. The speaker, Clive Thompson, suggests that in the stock market, it makes sense to diversify by investing in a broader range of companies, including mid-caps, small-caps, and foreign stocks, where valuation multiples are generally much lower. Don't forget to subscribe and hit the bell icon to stay updated with our latest videos.
We had roughly 10 years from about 2010 or 11 when gold did nothing and the stock market went up maybe 3 times. That was in complete contrast to the decade before that when gold went up 3 times, something like 300%, when the stock market went negative. So the S&P 500 went down over a decade and gold went up a lot. That was from 2000-ish until from when the stock market crashed in 2000, the dot-com bubble burst, through to about 2010 or 11. And then we had a period when the stock market was the star performer, and still is, by the way. So people have looked at the gold price that they had, and many of them bought it at the end of the bull market in 2010. And they're saying, I've had it for a decade, it's done nothing. And it's just a little bit above my purchase price, but look what I would have made in stocks. So they're selling out of it. I think there's a huge amount of nervousness about the gold price. That will dissipate over time. And eventually when the bubble, I'm going to say it's a bubble, but let's say the huge rise we're seeing in the top 10 stocks in America, when it comes to a halt, as it surely must do at some point, and I'm not a bear here, I'm just saying it's got a little bit ahead of itself, but when that stops and pauses for a reasonable length of time, people are going to be looking around for other things which are rising, and of course gold could be one of those things that they move into. As to my price projection, we're about $2,500 now. It would be quite a thrust to get to 3,000, which was, for many, the year-end projection. I think it's still possible. We've got a few weeks to go, and it could move very, very fast on very little news. But I think we will probably move a little bit higher before the end of the year. But when we go into the new year, people and investment managers are going to be looking for the story of the year. And as they go into the 31st of December, they're going to want to be holding those hot assets, the NVIDIAs of this world, the things which have gone through the roof, because that's what their clients will be saying. Do you hold any NVIDIA? Do you hold any Bitcoin? Those sort of questions, because they're hot assets. I don't think they'll be getting that many questions about gold, but once they pass the 31st of December, it'll be time for a little bit of portfolio rejigging. And I think that a lot of investment managers will increase their exposure to gold, bearing in mind that stocks have done so much better and it's maybe time for a catch-up in gold. Where do I think it's going to go? I think we'll probably go somewhat higher in 2025. My target for 2026 is, I think we'll be well within the range of 3,000 to 7,000. I'm going to say high 5,000s probably. And that would merely be playing catch up with the level of government debt. The amount of the amount the government debt has been increasing since 1971. So just playing catch up would take us into the high 5,000s. But of course, it would have to go an awful lot higher if they wanted to have any form of backing of the currency with gold. There's no suggestion that they're thinking of that at the moment. But if we get into a currency crisis and there's a generalized level of distrust for some reason, and that's not looking likely yet, but it could happen for some unforeseen reason, then they might have to back the currency by something. And if they were to back it, there's no way they're backing it at $5,000 an ounce. It's going to be $100,000 an ounce or $70,000 an ounce or $150,000 an ounce. It would take that sort of level of gold price to cover the amount of national debt that they've got. These technology stocks are trading at very high multiples where the amount they're earning for their shareholders is way less than what their shareholders would be getting on a time deposit. But on the other hand, they've got the capital growth. When I say capital growth, the share price growth, because that's what's happening. The shares are rising and rising. And of course, these companies are doing very well internally. They're producing huge increases in profit, sometimes as much as 100% increases in profit, 100% increases in sales. But there's still an awful long way to go before we get to any sort of reasonable price-selling ratio. So even if you look at 5 or 6 years' time, only by then be making a normalized level of profit where you say, I'm getting enough. But by then, a lot of the growth might have gone out of them, and one or two of them, I'm betting, will have fallen by the wayside anyway. So so let's say one or two have fallen by the wayside. So you lost out of the top 10, you've lost 20% of your value out of that, and the others have all seen huge growth in their earnings and sales, but their multiples are now trading at more normal multiples, and therefore you haven't actually made any money on them at all. You just trod water for a decade.
The government's spending habits, particularly on non-discretionary benefits like Social Security and Medicare, create an enormous fiscal burden. Politicians face strong reluctance to reduce these benefits, and while tax increases could occur, they wouldn't significantly reduce the growing deficit. The deficit, already at record levels, is fueled by mandatory spending that cannot be easily cut, leaving little room for adjustments. The debt has grown much faster than the economy, mainly due to borrowing at low interest rates in the past. As this debt matures, it must be refinanced at higher interest rates, further increasing the debt's cost. Clive Thompson highlights that the Federal Reserve's tapering program is adding to the pressure by reducing its balance sheet and selling government bonds. This is creating a larger supply of treasuries in the market, which, combined with the increasing deficit, is pushing borrowing needs higher. The government must borrow more to cover its deficit and the rising costs of debt service. The Congressional Budget Office forecasts that, without significant changes, debt to GDP could rise well above 200% and potentially even reach 300%, pointing to an increasingly unsustainable fiscal trajectory. Now let's dive into the interview.
And having got into the habit of printing, they carried on to some extent. And then along came the COVID crisis. And once again, everybody who was now locked up at home got their furlough payments and were being paid. Now we've gone back into a new world where they've had that budget, they've been spending it. Politicians still want to spend the money. Taking away people's benefits is a very hard thing for any government or any politician to do. The politician who says, I'm taking away your benefits, won't get voted for. I think there's going to be a huge reluctance to take away any of the Social Security, Medicare type of benefits. On the other hand, will they raise taxes? Well, they could, but they're not going to be able to raise them that much. It won't make that much of a dent in the deficit. So the deficit is the difference between what they're spending and what they're collecting in taxes. And they're collecting far less in taxes than they're actually spending on everything else. The trouble with the spending is 2/3 of it, they have no discretion at all about. It's called non-discretionary spending. It's the benefit system. Another one sick is the army, and they're not going to stop spending that. And the remaining sick is perhaps what they call discretionary. But I don't think they're going to make much progress on that one sick. And even if they did, it wouldn't get rid of huge deficit, which is being generated each year. It'll reduce it slightly. So the deficit, which is at record levels, is set to continue to grow. Meanwhile, we've got the very large government debt, which has accumulated at a much faster rate than the gross domestic product. It's accumulated faster than the economy. which a lot of it was that debt was taken on 5 years ago, 10 years ago, 6 years ago, at a time when interest rates were effectively zero. Now, as they were borrowing long term, they weren't borrowing at zero, but they were borrowing at 1 or 2%. So that debt, which had a lifespan of anything from 2 to 30 years, but a lot of it maturing over the next 5 or 6 years, that debt, as it matures, they stop paying interest on it at 2%, but they have to refresh it. They have to borrow new money at the new rates, and the new rates are double the old rates. We're talking about 4% plus, 4.5% actually. What we have is a much bigger pile of debt than we had over the last decade, which is having to be renewed at much higher interest rates. And on top of that, we have an ever-increasing deficit, increasing compared to GDP as well, which they have to borrow for that as well. And again, that has been borrowed at the higher interest rates. And last but not least, we've got at least we've had in the last year or so, the Federal Reserve it has its tapering program, which basically means it's trying to reduce the size of its balance sheet by selling government bonds. They've sold about $1 trillion of government bonds in the last year or so. All of these are creating a much larger supply of treasuries coming to the market, and it's the government's having to borrow at a faster and faster rate, not only to finance the deficit, not only to deal with the effect that the government, the Treasury, the Federal Reserve is not buying these bonds anymore. They're actually selling them to finance the interest on the national debt at a faster rate. That debt is getting, it's not, I won't say it's out of control, but it's going to get out of control. And that is the forecast of the Congressional Budget Office, the government itself, forecast that the level of deficit, of debt to GDP, which currently stands at around 100% if you take into account the debt issued to the public, they're forecasting that's going to go above 200% and maybe 300%.
The speaker highlights the U.S.'s growing fiscal challenges with rising debt, high government spending, and an unsustainable deficit. Gold is expected to catch up with the increasing debt levels, with a 2026 price target of $3,000 to $7,000, potentially higher in a currency crisis. Investors are advised to diversify, considering the overvalued tech sector, and explore assets like gold. Meanwhile, the government's inability to reduce spending and the Fed's tapering program significantly pressures an already precarious fiscal situation. What factors could lead to a significant rise in gold prices beyond the projected range of $3,000 to $7,000? Given the political reluctance to reduce benefits or raise taxes, how might the government address the growing deficit and debt? I appreciate your support. We're glad to have you along and genuinely appreciate your feedback. Don't forget to like, comment, and subscribe to stay updated on all our future content. We're excited to continue this journey with you.